Sure. So I think before we speak about alternative, assets, I think we can talk about a more traditional type of real asset that I think kind of illustrates why they're it makes sense to go look at and other areas on the market. So there's a publicly traded company, Arbor Realty. It's a mortgage REIT. So their business model is they're a lender and they own a portfolio of mortgages, bridge loans, mezzanine loans, et cetera, against real estate. And they're out in the market today marketing a new, I think it's a 5-year unsecured bond deal, talked at, 8.5 to eight and three quarters percent. So that's actually
Unsecured.
unsecured. Yeah.
Okay.
So that's a relatively decent yield. I'm sure it's going to get done. It may even price tighter than where the talk is. But when we look at something like that and we look, okay, well, this company also has a 13, 14% dividend yield, that suggests to us that maybe the market is a little concerned about the underlying asset portfolio here. Maybe they're not going to be able
Right.
to service their obligations, whether it's debt or their dividend. Maybe there's concern the dividend's going to be cut, um, and just general uncertainty over the underlying portfolio. And so rather than, I think, maybe go out on a limb, and try to ascribe value to some of these mortgages that they have. Maybe the LTVs are aggressive. Maybe there's debt service reserve problems. Maybe there's a high level of PIK interest. I actually don't know, so I'm not trying to make an accusation against the company. But there are all these things that could suggest that maybe things are a little bit worse under the hood than anticipated. And so for us, you know, while a headline yield of just under 9% sounds really interesting, if the underlying assets uh, don't make sense fundamentally, it's just not going to be something that I think is worth our time to take a hard look at. And so I think so that leads us to, you had mentioned maybe an opportunity in more alternative
Right.
type of real assets. So I guess, what are alternatives? I think when we think of alternative real assets, it's going to be anything with stable recurring cash flows, that's maybe anchored by an asset that's maybe it's regulated or it's scarce, but it might not fit neatly into a more sort of traditional real estate bucket like office, industrial, et cetera. I think we're thinking of things like spectrum licenses or cell towers, taxi medallions, gaming licenses, renewable credits. I mean, I think even these AI data center projects could maybe fit into this bucket, as well. But the commonality across all this is that these are going to be assets that are relatively essential, to how their industry operates. They may be supply constrained, and maybe there are opportunities for cash flow improvements with better management. But you approach it the same way that you would approach any sort of physical property or other asset class that we would invest in. What's the hard asset value? What's the cash flow, and how durable is each? And these are all characteristics that you can figure out, even if it's something that seems like it's a little bit more off the beaten path.
Okay. Let me ask you this, Spencer. Why do you think that these type of assets kind of get mispriced or overlooked compared to, traditional real estate and other type of real assets? I mean, what kind of sets what kind of sets this apart a little bit?
Well, sometimes I think these assets may sit in markets where, maybe there's a headline narrative that's worse than reality, or maybe there's just not much known about it, or more common biases, that someone might not be just aware of. I mean, you might hear like gaming license, well, what's that? Why is that something that's going to have value, or that you can price? Maybe there's temporary disruptions. Technology or new competitors come in that causes forced selling or a panic. That can happen. But I think the key for us is if you try to strip out a lot of the noise and just focus on what the underlying economics are, you can see that I think a lot of these assets have much more stable cash flow profiles, or supply and demand dynamics that actually could be structurally insulated from disruption. But it's the sort of thing that you have to kind of maybe dig a little deeper to truly understand. And again, just to emphasize, some of these things, you might hear that it's something that could be interesting, and the first reaction is like, I've never heard of that, or how does that even work? But that can lead to opportunity.
So speaking of opportunity, talk about maybe an example or two, in the market right now that sort of fits this framework and kind of how you look at it.
Sure. So I think just to go all the way, maybe over to the far end of picking something that when people hear about it, they might say like, "What are you nuts?" But that's taxi medallions, specifically
What are you
the
nuts?
exactly, but specifically the New York City taxi medallion ecosystem. This is a space where I think there is emerging opportunity for an investor like ourselves to participate in. And it's a market where I think that most people would probably assume that it has been permanently impaired by the likes of Uber or Lyft or other sort of rideshare apps. But it's really interesting. Like it's the sort of thing you look at the data and you spend the time to dig in and learn about it. Um, and I think from the high level, it's the data concludes that Uber, for example, didn't kill demand. What it did was it impacted the driver supply. So the core ecosystem there, the riders are there, the need for these products are there. But what Uber did is they presented the drivers with what they thought was a better alternative than driving under the medallion system. And so what has happened over the last really just couple of years is that there's been a fairly broad restructuring in the area backed by the um, New York regulators, in part driven by there was a lot of turnover of the underlying loans that were collateralized by the taxi medallions. The taxi medallions used to be very expensive, one and a half, $2 million, and to afford this, you take out a loan. So all these medallions were backed by loans that were held by banks. And over time, as you had the disruption from the rideshare companies, these loans lost value. And
How
what ended
many
up,
how many loans, how many of these medallions are out there?
well, I don't know if I can say for sure exactly how many medallions are out there, but there's certainly several thousand that
Wow.
are
Okay.
out there, you know. And so this actually, if you think there's 5,000 medallions out there, for example, and people were at one time valuing them at $1 million, that actually turns into a relatively real market. And so what ended up happening was a lot of these loans ended up trading hands at deeply distressed levels. And the buyers worked with the city of New York to restructure the way that a lot of these loans are going to work. In part, in certain circumstances, actually establishing a guaranteed value for a large part of these loans. So if at one time, people thought that these assets could be worth, $1 million, for example, and believe it or not, loans transacted, below $200,000, or $150,000. A large portion of these loans are now backed at, around $170,000, which sort of establishes a floor. And if you wanted to just outright own taxi medallions, that's no different than owning, an operated leasing business. So you own the medallions, you have the drivers, it generates a very predictable, steady stream of cash flows that have real value and is relatively predictable.
Okay. It's very interesting. And yeah, I mean that's the type of kind of esoteric type of idea that I know you've really got to dive in and do a lot of serious credit work on. So that's very interesting. As we kind of, start to wind down this year, are there any other type of opportunities that are similar that kind of get your juices flowing a little bit?
Well, I think what I would say is just to follow up on the point is there's actually an opportunity for folks to participate in this taxi market in the public markets. There is a BDC more or less called Marblegate Capital Corporation, and this
Mm.
company went public um, maybe about a year ago. And what they did is they essentially IPO'd through a de-SPAC transaction a portfolio of these loans that are backed by taxi medallions and a portfolio of operated and owned taxi medallions. And the way that we look at that particular company is, at these levels, you basically have three assets. You have the loans that are backed by the New York City guaranteed level. You have a smaller portfolio of loans that are not yet guaranteed and have higher loan balances, and then you have a portfolio of owned uh, medallions that you're going to be able to run an operated uh, leasing business on. And what we think is really interesting is that at today's levels, you can sort of buy the portfolio of the guaranteed loans at a discount to their guaranteed level. And so you're essentially creating the other two options more or less for free, as people might say. But it's a really interesting opportunity. I think a lot of it's sort of on the come. But again, it's a situation that you hear about, and the first reaction is like, no freaking way. And you do a little bit more work on it, and the reaction still might be, no freaking way. But eventually you get there, and like value is value. Um, and we think that the company managing this is highly incentivized to make it work. We think they're highly aligned with the new administration in New York City, who was part of the restructuring. So,
That's a
you
key
know,
right there.
exactly. So, something like that should work out.
Well, and it just goes, just another example of kind of your philosophy that you've got to have a measure of downside protection and that a return of capital is more important, certainly than a return on capital. So, uh, Spencer, thanks so much for sharing that with us. That kind of wraps up our call today and for the year. So, we're going to leave it there. Thanks everybody for joining us. And we'll look forward to talking with you here as the clock strikes 2026. I'm Mike Flaherty, and in the meantime, happy holidays to everybody. Thank you.